Welcome to CAP STRAT This Week. My name is Mike Warford, pinch hitting just for this week for Will Woodall. With us as usual is Mike Rarey. Welcome, Mike.
Welcome, Mike.
Thank you. Happy to be here.
Yeah.
We've got a lot to cover this week. It's been another eventful week in markets. We're primarily going to be talking about the repercussions of the Jackson Hole Symposium that wrapped up towards the end of last week. But we'll start with a review of market activity for the week ended August 25th, specifically looking at global equities. And as you can see here, Mike, a couple of pockets of green, a couple of pockets of red, but looks like the S&P 500 giving us a green week for the first time in some time.
Yeah, we ended a 3-week losing streak with the S&P up 84 basis points last week. Pretty much all those gains came Friday. And, it was a very choppy week. It's really been a very choppy month. We haven't had consecutive up days all month. And if that continues through the end of the month, that will be the first such month since 2002, which was, when we're struggling with the tech bubble burst. So it's been very rocky. And, obviously some gains on Friday, digesting Jackson Hole Symposium on Thursday, and also post-NVIDIA earnings was a big day as well. Thursday, the NASDAQ down 2%, even though Wednesday afternoon, NVIDIA released earnings that absolutely crushed expectations.
That 2023 market darling, NVIDIA, not getting rewarded quite as well here lately.
Right.
One thing that was particularly interesting, you can see emerging markets up pretty notably, outperforming developed markets by almost 1%. That despite Chinese equities falling.
Yeah.
What's going on there?
Chinese equities down again, down over 10% for the month. And this is despite officials in China basically pulling out all the stops to try to stop the slide. Limiting IPOs because we don't want to have excess supply of equities on the market, lowering the stamp duty on stocks so they're less expensive to trade, restricting the size and frequency of refinancing, encouraging investment funds to not be net sellers, encouraging companies to buy back stock. And despite all of that, Chinese equities continue their slide. And more interesting, this actually happened today, not last week, but China Evergrande started trading again after a 17-month trading halt, and it was promptly down 79%. So whatever they're doing right now, they're pulling out all the stops. It's not really working yet.
It is interesting, the worst day of the week, right after NVIDIA posts impressive earnings results. What's happening there?
Yeah, it's a bit of what we've been seeing all quarter, and so we show out that data here. Basically what we're looking at is, this is the price action, so 2 days before reporting and 2 days after reporting, of S&P 500 companies that posted positive EPS surprises. And this is quarterly data going back to Q3 2018. And what you can see is in the most recent quarter, which we're pretty much done with earnings at this point, positive EPS surprises are not being rewarded by the market. On average, companies that post earnings beats are actually down 0.5% from the 2 day before to the 2 day after period. And that's sort of the worst reward or lack of reward, the worst dynamic we've seen, going back to 2011. On average, over the last 5 years, if you're a company and you beat earnings like NVIDIA did, you would see on average a 1% pop in the stock. And so to not see that pop in NVIDIA after absolutely destroying expectations, and the expectations were lofty, right? And then more so seeing the rest of the market, the other stocks that trade like an NVIDIA, seeing them down on the news, if you're a bear, you would look at that and say that is sign that the market rally perhaps is becoming exhausted.
Yeah. And so the market says you have this high bar, you beat this high bar, and now your stock is worth less.
Yes.
And that seems illogical.
Right.
You think if you would beat earnings, your stock should go up. Why is that not the case?
Yeah.
Why is this happening now?
Well, weird stuff like this tends to happen when valuations get very frothy or at extremes. We talk a lot about our investment framework, obviously. We go through the macro factors that matter, inflation, liquidity, economic growth, recession, like we will. But the other part of the framework is valuations. And so we wanted to show that here today for the viewers. And what we're looking at, these are our valuation signals for large value stocks in purple and large growth stocks like NVIDIA in the light blue. And basically how we measure this, how we value an asset class in the framework is, what's the long-term trend return of the asset class? How far away are we from that long-term trend? Are we well above trend, implying, we might be giving back some gains in the future? Or are we well below trend, meaning we have some catching up to do? Momentum, how quickly is the stock rising or falling? And then finally, how attractive does it look relative to cash? So cash yields have something to do with this. And we recently have seen our large growth valuation signal trigger in terms of expensiveness. So if you look there, large growth stocks in about the 86th percentile of expensiveness based on our data going back to 1960. That's very unattractive. That implies little to no returns and actually underperforming cash going forward once valuations get this extreme. And that's the 3-month moving average. We do that to sort of smooth out the signal. But the reality is in July, this measure got up to 96%. So 96th percentile of expensiveness. The only other time we've been near that was right before the tech bubble burst in the early 2000s. So when valuations get at these levels, it's clear that the stock market has already priced in perfection for a stock like NVIDIA, for a lot of the Magnificent Seven. And now the stock has to grow into the multiple, so to speak. So, if you look at this chart, you might say what happened with NVIDIA, not all that surprising.
Sure.
Right.
And speaking of high expectations and trying to thread a needle and please the market, we can move on to fixed income and the Jackson Hole Symposium. Anything to wrap up on equities or alternatives before we get there?
We can touch real quick on alternatives, just showing a bit of a relief rally for the week. But then, we want to dig into the Super Bowl of central banking.
Oh, yeah.
The Jackson Hole Symposium. So.
Yeah, as we mentioned at the top, a lot of market action this week due to anticipation and reaction to the items coming out of Jackson Hole. If we take a look at fixed income performance here for the week, we can again see some pockets of green, some pockets of red. The biggest trend here for the week ending August 25th is somewhat of a re-steepening of the yield curve. You can see shorter term yields, the 2-year Treasury down 13 basis points for the week as short-term rates rose. On the other side of the curve, longer-term rates falling, leading to positive returns, the 30-year Treasury up nearly 2%. So, Mike, anything important come out of Jackson Hole last week?
Yeah, well, that's in the eye of the beholder. For us, the point of Jackson Hole Symposium is to see what central bankers are thinking about in terms of how they're going to implement monetary policy over the long term. What structural shifts might they have in their analytical framework? Because if you want to predict their behavior and their reaction function, you need to know what information they're taking in and how they're factoring it in. And just because it's the Super Bowl doesn't mean it's going to be all that exciting. This one you sort of had to dig into the details. So what we've done is we've taken a few of the quotes from the keynote speech and some other papers, and we can sort of dig into those here. And this is the first quote, and pull this up and you say 2% is and will remain our inflation target. That was in Jerome Powell's keynote speech. And question would be, why is that a key takeaway? That seems pretty apparent or goes without saying, right? But the title of the symposium was Structural Shifts in the Global Economy. And the whole idea behind it was there are structural long-term shifts within labor markets, within global supply chains, within government spending, within finding reliable sources of clean energy that might mean that we are permanently in a higher inflationary regime. And Jackson Hole is an opportunity if the Fed were to say, we are structurally in this new regime, we're going to move the goalpost. We're going to accept something slightly above a 2% inflation target, or within the range of 2%, or below 3% as our target. Maybe hint at moving the goalposts in the future. This would have been an opportunity to do so, and Jerome Powell came out immediately, multiple times in his speech, and said, no, 2% is our target. So, why is that significant for asset markets? Right, financial markets. What does this mean for a portfolio, right? And there were hints coming into Jackson Hole that this might be the opportunity where they move the goalposts. And so think about how that would get reflected in the bond market, right? Start at the short end of the Treasury yield curve. If the Fed changes the goalpost, and now instead of needing to get down to 2% inflation, they only need to get down to 2.5 or 3, they're going to get there sooner, which means they could potentially cut short-term interest rates sooner, which means shorter-term Treasury yields, like 1-year, 2-year yields, would price that in. They would fall.
Start going down. Yep.
Right? So that's what would happen at the short end of the yield curve. You'd have shorter-term bond yields come down to price in easing would happen sooner. We're going to reach our goals sooner. And the long end of the bond curve would do the exact opposite. You'd say, all right, well, if the Fed's going to cut sooner, recession is less likely. Less time in restrictive monetary policy stance theoretically means lower recession probability. So that should push up longer-term bond yields. And if we're willing to accept something above 2% inflation, that's what's baked into those longer-term bond yields. So they would have to move up because of that, accepting a higher inflation number. So you could have a re-steepening or uninverting of the yield curve, which is what we've seen thus far in August, right? We've generally seen a re-steepening, and the consequences of that, particularly long-term bond yields going up, that is a very negative environment for interest rate sensitive asset classes like equities, particularly growth equities, which are having their worst month since December, and very difficult for interest rate sensitive sectors of the economy like housing affordability back down to the worst that we've seen in, I don't know how long, like 2000 or something like that. Yeah. So that was the whisper. That was sort of why markets might have been moving the way they were heading into the symposium. And Jerome Powell took advantage of the platform and say, nope, absolutely not. 2% is the target. Cut it out.
Yep.
Right?
Did not take that opportunity. Shut that down pretty early on.
Exactly.
In his planned comments.
Yep.
So you have this first message of we are not shifting our inflation target. You can take that down the thought process to say they're not as likely to cut soon, which means they could start running into ends on the other side of the spectrum, potential concerns around economic growth or economic activity. Any indications around what they're looking at there?
Absolutely. And so a question is, okay, you're done hiking, you're going to leave rates higher for longer. How will you know when the job is done? How will you know you've achieved a soft landing? There's this rosy idea of an immaculate disinflation, where inflation will just come down and we'll just say, all right, our job is done, let's cut interest rates. One of the signs they're looking for, in our view, which will probably be too late once you see this, is they need to see softening of the labor market. And we've talked about this over and over again. If you wait until you see softening of the labor market, you're probably already staring a recession right in the face. So that's going to be really tough. It's going to be tough. If that's what you're looking for in order to cut rates, you're probably going to err on the side of leaving rates too high for too long and downside risk to the economy. So we thought that was a key point in terms of their reaction function.
Yeah, and while they may not have any type of clear indication of when the job is done, it sure seems like they're going to keep trying until they find out, right?
Absolutely. And so these were other quotes from the conference, 2 of these in the last part of the speech. We are navigating by the stars under cloudy skies. One, for all the nerds out there, that's a throwback to his first Jackson Hole Symposium speech when he talked about U star and pi star and R star and all these things. Under cloudy skies. There was so much humility in the speakers at this conference. Central bankers are in agreement that they don't know. It's very difficult how to proceed forward. Their models are not working like they used to. It seems like the economy is going through these changes. Historical relationships aren't making sense. They are navigating by the stars under cloudy skies. And then finally, the last line, we will keep at it until the job is done. That was how he slammed the door on markets last year. You know, the S&P 500 after his speech last year fell 15%. Yeah. It clearly wasn't that way this time around. But just showing, hey, I'm going to end it the same way. We are resolute in defeating inflation. Yeah. You know, to us, that leaned hawkish. Sort of, we need to see softening of the labor market. We kind of don't have these good theoretical idea how this is going to work out. This seems different. And we're just going to keep going until it's done. Yeah. And so potentially, in our view, hawkish, leaving rates too high for too long.
Yeah. Jay Powell, big fan of the callback, as we saw there. So fair to say, correct me if I'm wrong here. It seems to us coming into Jackson Hole, the Fed was pretty set on trying to find this middle ground, have the soft landing. Markets thinking maybe they'll change their inflation target, maybe we'll get some more guidance around cuts. But the comments here seem to be somewhat clear. We are more interested in keeping rates higher, and bringing inflation down, keeping our 2% inflation target, than we are trying to kind of thread the needle and leave ourselves exposed to both errors on both sides.
I think that's exactly right. Yep.
Awesome. And so, diving a little bit further into Jackson Hole, we're accustomed to Jackson Hole being an arena for kind of previewing shifts in monetary policy. But what kind of adds to the importance of this particular symposium is we're in this environment of U.S. debt being downgraded, repeated debt ceiling talks. What kind of indications, if any, have we gotten in terms of what are our global central bank policymakers looking at when it comes to those types of arenas?
Yeah, that's right. So personally, and you as well, one of our favorite things to do is read all the papers that get presented. I mean, if you're in academia and you get tapped to present at the Jackson Hole Symposium, it's like being called up to the Super Bowl, right? And so this is what the world's central bankers are interested in, and this is some of the leading research and academic thought. And two of the papers that we thought were very interesting because it haven't been talked about in prior symposiums. First one, living with high public debt. And the idea is right now, basically all developed economies are very highly indebted, tremendous debt levels. And fiscal spending continues, deficit spending continues. And just realizing the fact that we really are not prepared to reduce this debt burden without some friction. Meaning we don't have the political solidarity to just come together and say we're going to cut spending. That's clear. Inflating your way out of debt is very risky at this point in the game, right? And growing your way out of it, just growing the economy at these debt levels with interest rates this high, outgrowing your debt burden, that seems like it's going to be difficult as well. So economies are going to be living with high public debt and increased spending, and that's just going to be a fact of life. And then the next one, which sort of tags onto that, resilience redux in the U.S. Treasury market, which basically shows or proves out that, hey, if the U.S. government and other governments are going to be issuing way more debt in the future, more Treasury issuance, more deficit spending, et cetera, somebody needs to buy that debt, that treasuries, those treasuries. And the Fed's trying not to because they need to fight inflation, so they don't want to be buying assets. They're doing quantitative tightening. Foreigners increasingly are not buying our debt because of geopolitical divides and things like that. And so the burden of financing the U.S. public debt is going to fall on the private sector, on you and me. And before it falls onto us, it's going to fall on the burden of the U.S. commercial banking system. They need to take down that debt at auction and warehouse it. And they have finite balance sheets. They simply do not have the capacity to do it. And so that's going to create potential issues that are going to be financial instability problems, economic growth problems, issues in the commercial banking system. All of these things together are basically showing that perhaps fiscal deficits, government spending is undermining central bankers' ability to fight inflation. This is very late 1960s, 1970s-esque. Where the Fed as an independent authority trying to bring down inflation, the government spending.
And so who wins?
Oof. That's it. Well, it took like 10 years to win the last time. We will see.
All right, so we've had all this talk on Jackson Hole, central bank policy. Of course, central bank policymakers are driving the economy, but why is that important for asset prices?
Yeah, great question. Once again, why does this matter? Well, the overall take is, most central banks are going to leave rates higher for longer. They're not going to be buying assets. They need to fight inflation. They're resolute in that, et cetera. We've showed this chart before. central bank balance sheet index in light blue. You take the assets of all major central banks, combine them, convert them into US dollars, rescale them something that moves more or is scaled appropriately with the S&P 500 price. And these lines sort of lay right on top of each other. When central banks are buying assets, lowering interest rates, light blue line is going up, stocks go up, S&P 500 in dark blue. And when the opposite happens, central banks are fighting inflation, reducing the size of their balance sheet, raising rates, stocks go down, liquidity, basically. And the other thing that's interesting now is you see the central bank balance sheet index coming down sharply right now. Every single central bank in this aggregate is resolute on fighting inflation and is trying to be restrictive, with the exception of China. And this speaks to the other thing that's happening here. If you're one of these central banks and you need to cut interest rates, perhaps out of a position of economic weakness, at this point, your currency is going to weaken so much because all central banks have these attractive short-term interest rates that the light blue line is just going to keep going down. The yuan has weakened versus the US dollar more than they've actually added to their balance sheet.
Wow.
So it's sort of like, you have to run faster just to stay in the same place,
Right.
the red queen theory, if you will. So very difficult environment, and it would suggest that the fair value for the S&P is much lower than it is today.
All right, and so with that, we can get into the highlights on the investment framework, starting with liquidity.
Yeah, not a huge update here. Liquidity still low and rising. Almost no year-over-year change in money supply going out on our forecast horizon. And this is exactly what central bankers have been talking about. They need to keep interest rates higher for longer to try to defeat inflation. That's what that looks like from a liquidity perspective. So very difficult environment.
Gotcha. And how about on the inflation front? We talked about the Fed, staunchly keeping that 2% inflation target. How are the forecasts looking there?
Well, we talked a little bit last week about how Q3 economic data, incoming economic data, has been very strong and could perhaps lead to a resurgence in inflationary pressures. So you see that, the dark blue line, headline CPI, coming back up over the next 12 months. And then you see now at the very end of our core CPI forecast actually starting to tick up at the end. So, these are the long ends of the forecast. We have the least confidence in the longest, the 12-month out versus the 3-month out. So we'll see how this evolves. But if this economic reacceleration continues, it might have to be met with higher interest rates. I mean, we need to see the labor market soften in order to be confident that inflation is going to come down.
Absolutely. Yeah. And speaking of labor market softening, thoughts around economic growth, potential for recession?
Economic growth right now, this week we're going to get the updated Q2 estimate. We'll get that at the end of the week. And also we're going to get Q2 gross domestic income, which will be a good check to see where the economic data might get revised down to. So looking forward to giving updates on that next week. But aside from that, we've just seen an increase in estimates for Q3 because the data's been coming in hot, but not a huge increase in estimates as we go further out.
Awesome. Then on the recession signal front, our yield curve signal has been active for some time here. Any other signals that we're keeping an eye on?
Yeah, still inverted, even though we saw some steepening of the yield curve going into Jackson Hole, still heavily inverted. I mean, we're talking about on the margin here. And then the labor market signal still sort of in that yellow-red warning area. We haven't seen initial jobless claims continue to move higher. We have seen non-farm payrolls continue to slow, and we'll get the next non-farm payroll report this Friday, so looking forward to that. The only other wonkiness there is the BLS did their benchmark revision, and it turns out they believe from March to March, that about 306,000 fewer jobs in the U.S. economy than originally estimated. It's actually a little smaller of a downward revision than was expected, so not a big deal. Doesn't really move the needle.
Important to note that that's normal course of business.
Right.
Some fun headlines about 1/3 jobs disappearing from the U.S. economy. That is not the case. Benchmark revision, standard part of their annual process. I'll just point out on the recession signal front, it's just notable that the area where we're seeing some yellow and red is the particular area of the economy that Powell said, hey, we're starting to see some slowdown here. This is an area that we're going to be looking at when determining monetary policy going forward. So certainly important to keep an eye on the labor market indicators coming in here. Well, that's all we have for you this week. Thank you for tuning in. We appreciate it. If you have any questions or would like to discuss further, please feel free to reach out. Again, I'm Mike Warford, filling in for Will Woodall, and this is Mike Rarey with CAP STRAT This Week.